Hey, what's going on, everybody? This is Anthony here, I'm your trusted advisor, and today I'm going to talk to you about how to pay off your mortgage 10 to 15 years early. Now, first, I want to talk about two of the biggest mistakes homeowners make trying to pay off their mortgage early. The first mistake is number one, you put too much money down. Somewhere you heard put 20% or more. The second mistake is you make extra payments each month on top of your mortgage. If your mortgage is $2,000 each month, most people are putting an extra $500 so they can pay their mortgage off faster. Now, I'm going to tell you why this is wrong. First, if you're listening to your banker, your real estate agent, your mortgage broker, family or friends, or some type of article online talking about make extra payments to your mortgage or put a large down payment down, stop listening to them because they're giving you the wrong advice. It's costing you thousands of dollars. First, let me explain why. First you have person A. Person A has a mortgage of $300,000, 30 years, at 4.25% interest rate. Now this person puts 20% down, which is $60,000. Why? Because they listen to their banker, the real estate guy, their family and friends putting 20% down. Their monthly mortgage payment is $1,181. So they pay $1,181 a month, and they put in an extra $500 down. So they put an extra $500 towards their mortgage because they want to pay it down. Now let's think about this for a second. So $500 for 12 months, that's $6,000. $6,000 that they're putting towards their mortgage each year. So you're telling me that they're giving the bank an interest-free loan, right? Just imagine if the bank took that $6,000 and they gave it to somebody with a credit card balance of $6,000 and say, hey, you got this new credit card. The bank is going to charge them at least 15% and more, right? So that means if the person uses the credit card for the whole year, the bank is going to make $900 off that credit card right there. So you gave the bank an interest-free loan, they took that $6,000, gave somebody a credit card with that balance, charged them 15% or more, and if they use the whole balance for the whole year, the bank made $900. Okay. Now it gets worse. So let's say this person A, they follow their plan. If you do the calculation, after 18 years, that means their mortgage is paid off. Boom. The mortgage is paid off because they made the extra payments after 18 years. The extra payments equal up to $109,000. So 6,000 times 18 years is $109,000. Okay, so they reached their goal. The house is paid off. Okay, that's a good goal. I mean, there's nothing wrong with having your house paid off to have cash flow freed up. But is there a better way? Is there a better way to do this? All right, let's look at person B. So person B does the same thing. They have a mortgage which is $300,000. They got 30 years at the same interest rate, 4.25%. Now this person puts 4% down. They get an FHA loan, which is going to be around $12,000, right? Now this person B, they want to pay their mortgage off fast also. Okay. So they take the same $500 that person A over here is doing, but now they take the $500, instead of making extra payments to their mortgage, which is around $1,400 a month, now what they do, they take this $500, they put it in a side account. This side account, let's say the side account is 100% safe. That means your principal and your interest is 100% safe. You're not going to lose any money, right? So You take that $500, put into your side account, it's gonna be safe, but now your side account is gonna earn you interest. Okay, it's gonna earn you interest now. Okay, so that $500 for the year is going to be $6,000. Now, remember I told you about putting money down? What this person did, they only put 4% down on their house, which is $12,000. But they had an extra $20,000 that they didn't put towards the down payment. So what they did was they put that into their side account. So their side account, they started it off with $20,000. And then now they're going to add the extra $500 a month. It's the extra payments that they would have put towards the mortgage, but now they put it into their side account, which is $6,000 a year. Right? So then now, when you add all this up, if they earn 4% interest after 18 years, this account right here grows to $199,200. Wait, you follow me? You follow me? You get that? You get that? All right. So, I'm gonna do a quick little recap. 4% down of a $300,000, that's $12,000 down payment for person B. Now, they took the extra monthly payments, the same thing that person A was doing, but now they put it in a side account. So they took, and they had an extra $20,000. So $20,000 plus the money they put in towards the extra payments, now they have it all working for them. Now they have their money working for them. And after 18 years, at 4% interest earned on that money, that account is going to grow to $199,200. Now, just like person B over here, after 18 years, they pay their mortgage off. You know, the extra payments grew to $109,000. It's paid off. Now, person A, if they choose to pay their mortgage off, all right, so if they subtract $109,000, that means now they would have left 90 grand. So that means person B, mortgage is paid off, plus they have a $90,000 side account that still has money in it. Isn't that amazing? So which one would you choose? You know, person A over here, they just put person A, the money that they're putting towards their mortgage is not growing. It's not earning any interest. Nothing. You know, if you have your mortgage and you have equity in your house, equity has no rate of return. So even though you have all this equity built up in your house, you're not earning any interest on it. This guy over here said, let me put it in my side account right here. Let my side account earn interest and let that grow. And then also he put less money down. So person B comes out over $90,000 better than this guy over here. But hey, it gets even better for person B. What do I mean by that? So we said it earned 4%, they got about $199,000. What if this side account earned 5%? That means that this account right here they would have earned $224,000. What if this side account earned 7%? At 7%, they would have made $286,000. The only thing that changed over here is the rate of return on their money. You know, at 4%, $199. At 5%, they earn interest, $224. At 7%, they earn $286,000. But this guy over here, all he did was just pay off the mortgage, and that was it. His money didn't grow, not 1 penny, not 1 cent. Why? Because equity doesn't have a rate of return. But here's the thing. So let's just say person A and person B, they both have their mortgage paid off. both the mortgages paid off. It's 18 years right now, right? So let's just say some type of life emergency thing, some type of life emergency happened. You know, somebody gets sick or whatever the case may be, but they need some money. So person B over here, you know, he doesn't have any money, but he says, you know what, I have equity in my house. Okay, so he goes to the bank or whatever lender he goes to, the mortgage broker, and he says, hey, I need $30,000 of equity in my house. You know, so they have some type of emergency. So the lender says, okay, perfectly fine. You know, you can have that because you have the equity built up in your house. But first, we have to give you a application you have to fill out. Right? Application. All right, yeah, you have to fill out the application. First, we have to verify that you're still working. We need 2 paycheck stubs. Then we have to run your credit. We have to make sure you have at least a 680 credit score or better. All right. And then also, we have to make sure that whatever you're using the money for, you know, we have to agree to it. So what are you using your money for? All right. Now think about this now. You made your payments each month, $11.81 a month. You put an extra $500. That's over $109,000 that you put in extra payments towards your equity. But then now you want to get it out for 30 grand, and then the bank is telling you that you have to go through all these little checkpoints to even get it? Okay. So let's just say that everything the bank asks for, it lines up. Okay, your credit is good, 680 or better, you still have a job, you show proof of funds, you know, your paychecks, your pay stubs, and then also everything checks out fine, right? But then the bank says, okay, you are approved for the loan. All right, but then now the bank says, we're going to charge you interest on the loan. So the bank says, okay, we're going to charge you 7% on your money for taking it out through the home equity line of credit. So wait a minute. First I have to go through all these checkpoints, and then now you're going to charge me interest on my own money? Wow. Isn't that a bad deal? You know? All right. Now, person B over here, they paid their mortgage off if they wanted to. They had the option to. So at 4%, he had, 90 grand over here. We just used the 4%, he had 90 grand, right? So now, he has an emergency. He doesn't have to check with anybody. He doesn't check with anybody. He can just go to his side account and he can take out whatever he want to take out. You know, there are no credit checks. There are no, this person can have bad credit. They can not have a job. They can be sick and not been doing well. And they can go to their side account and get the money out. And they don't even have to tell anybody what they're going to use the money for. Nothing. Now, which deal would you want to have, you know? Now, it gets even better because, you know, the rate of return over here, like, now I'm not talking about putting your money in the stock market and risk losing your side account. I'm not talking about that. I'm talking about putting your money in a safe account where you can't lose it, but you can earn interest on it. And that money compounds and builds over the years. And now this money over here is tax-free. It's tax-free. Isn't that so much better? You know? So guys, thanks for watching my video. Please comment. Let me know which one would you choose, person A or person B. And give me some feedback. Let me know why. And let me know if you understood everything I said here. You know, if you are purchasing a home for the first time, then you know you can look into this. You know, the down payment and where you can find the money to put towards your side fund so you can have your money grow faster. And that way, if you choose to pay your mortgage off early, you can. Or if you do pay it off early, you still have that side fund, or you have an emergency fund. Now, if you already have a home, all right, you already passed the down payment stage, right? But what if you refinance? What if you refinance and you took some cash out and you put that in your side fund along with your extra payments? You know, you can do that also. So there's many options, there's many different things you can do. Or you can just stop making extra payments to your mortgage because you know why now. You know that extra money you're putting there is not earning any interest. You know, it's not earning a rate of return. So it's not in your best interest, it's in the bank's best interest, the credit card, you know, everybody else. But that money is better off in your pocket, not theirs. So guys, I'm gonna post up my free education workshop I'm having, all the details, you know, and hopefully you'll be there. And we can talk about things like this and other topics like college funding for the kids, reducing your debt, maximizing your retirement income, how to stop losing money in the stock market, you know, reap the upside benefits but never the downside risk, you know, when your principal and interest are 100% guaranteed and you never lose any money again, you know. What's his name? Warren Buffett said there's 3 rules to making money. The first rule is never lose any money. The second rule was to reinforce the first rule of never losing any money. The third rule was to reinforce 1 and 2, saying never lose any money. So don't put your money at risk. You know, go more towards safety and guarantees. So guys, this is Anthony Yard. Thanks for watching my video. Please like and comment. Give me some feedback. All right, y'all. Have a good day.